Hello everyone. So moving on to the last chapter of this FM, that is capital budgeting. See, capital budgeting. Actually, this capital budgeting chapter, like it has been focused more in final. In final, like CMA final, this capital budgeting chapter has been focused so much. Like it carries around some 20 to 30 marks, like 20 marks actually. Whereas here in this FM in Inter, this capital budgeting, you see, capital budgeting is nothing but how well the fund has been used, or evaluation of the two projects which will be effective. So these are the different kinds of viewpoints from this capital budget. So actually first I'll just clarify you what are the different concepts in this, like what is payback period, what is accounting rate of return, what is net present value. We'll just have a short discussion on all the topics, like randomly, like we don't want to cover all theories, but we'll just understand what are all the different terms, so that while doing sums you can understand, oh, this is why we are calculating this. Suppose payback period, like normally what is meant by payback period? Payback period means within how many years or how many months, within what period the capital which has been put in is taken back. Suppose you are investing 10 crores in a business, within what period you are taking back that 10 crores, that is not withdrawing. It's like from profits, within how many years you are earning that 10 crore, that is called payback period. Suppose we both started a company, we invested 10 crore rupees. So we are seeing what is the payback period. How to calculate payback period is, we should take all the profits earned for every year, and at which year and which month we cumulatively we are getting 10 crore rupees. Suppose we invested 10 crores on 2016 April 2016 we are investing. From that period till what period we are like 10 crore profits has been earned. Suppose you earn 2 crore profits in the first year, 3 crore profits in the second year, 4 crore profits in the third year, and fourth year you earn 5 crore profits. So all cumulative of this 3 years is 2 plus 3 plus 4, 9 crores. So at the end of after 3 years, that is between 3 years to 4 years, you are earning that 10 crore rupees which you have invested as capital. So that is called payback period. Payback period is nothing but within which period you are taking back. Taking back means you are earning your invested capital through profits. That is called payback period. So these are, like I have given you an example. We'll cover all the different topics, like to like how to say. See, to understand these problems, you don't want any different any special knowledge and all. If you do the problems, you can solve the problems easily. But the terms which has been used in the problems, it will help you later. Suppose now if I go and solve problem number 9, you will definitely understand problem number 9, and you can solve the problem number 9 in exam also. But covering this theory topic, what it will give you is, if suppose any experimental sum, if suppose the examiner is question paper setting people, they are experimenting through giving different terms. Suppose you have to understand what they have given. So you know this is payback period. You can, if they give calculate payback period, means you are going to calculate it very easily. But then instead of giving payback period, if they give some other term, so that you should arrive at payback period, then you should know what is this payback period. So that is why covering theory topic, we don't have to cover spend so much of time, because this is the last chapter of the FM. We should move on to costing. So it is already it has taken nearly 1 week to finish off all this theories, sorry, FM chapters. So we'll just have a random talk on this capital budgeting, so that we can have clarity over this concepts. So what is basically a capital budgeting? Capital budgeting decision may be defined as a firm's decision to invest its current funds most efficiently in long-term activities in anticipation of expected flow of future benefits over series of future years. So simple, capital budgeting is nothing but investing your capital today in a effective, efficient way, so that you are getting long-term benefits over a series of years. That is, suppose you have 1 crore rupees today, capital budgeting is nothing but that capital 1 crore rupees, you are going to make a decision of where to invest. Suppose you have 1 crore today, what you will do first? You will see where my, as a entrepreneur, like as a commerce student, I'm telling, if you have 1 crore today, not like a crorepati winner. Suppose you have 1 crore today, if you go and spend 1 crore today, then you are going to lose the amount. Whereas if you are investing that amount in a right business, if you are putting your amount in the right places, then you will be getting more money out of that capital. So that is called investing in efficient funds, that is long term funds. So basically capital budgeting is nothing but, if suppose you have 4 alternatives, what capital budgeting does is it will evaluate all four different opportunities, all four different options, so that where your return on investment will be more. So calculating this effective return on investment for different project is called capital budgeting. So that is the capital budgeting. So need of capital budgeting decisions. Why capital budgeting decisions is needed? For expansion. Suppose, see, you are already having a nice business. Okay, your business is giving you 20% return, and per year you are earning nearly 1 crore rupees as income, that is EBIT. Suppose you have a nice net profit, and using that amount, if you are planning, suppose every year 1 crore you are getting, why not open another branch? So if you are planning for another branch, if you are planning for expansion of your business, this capital budgeting will give you an nice idea, or it will give you an overview where to invest. So this capital budgeting helps there. Next is replacement. Suppose you have a machinery, okay, that machinery is very age old, you are doing repairs every year, you are repeatedly doing repairs every year, but then for purchasing new machinery also it costs heavily. So evaluating these two options, like whether to go with old machinery or whether to purchase a new machinery, you can arrive at that by calculating the average cost, that is cost spent at like every year how much of cost is spent, present value, by calculating present value of the average cost. That is, suppose for next 3 years, if you are using old machinery itself, how much is the total cost you are incurring, or if you are purchasing new machinery, what is the total cost you are incurring, converting all the cost into the present value, today's cost, and comparing both, where the cost is comparatively lower, you can go with that option. That is called replacement. So this capital budgeting helps in replacement. Next is diversification. Diversification is nothing but, you would have heard this in stock market, they'll talk about this, don't put all your eggs in the same basket. So that is called diversification. So suppose if you are having 1 lakh rupees, that 1 lakh rupees you don't know what to do. Suppose some people, like due to this pandemic situation, gold price have hit like sky high. So people would have come and told you like, okay, invest in gold, you will get nice returns. So if you have put all the 1 lakh rupees in July month, or suppose in May month in gold, today May month it was like around 4,500, and today it is around sorry, June month it was around 5,000 rupees and 5,400 rupees, whereas today it is only around 4,800 rupees. So if you have put everything in a single basket, that is gold itself, you will lose your capital. So instead of losing your capital, you can diversify your funds. So that is called diversification. For that, capital budgeting will be helpful. Next is buy or lease. This is very important. In final, nearly some 10 to 20 questions. Seriously, this buy or lease, it will be like, till you are saying enough, you will feel like, okay, this buy or lease, I am done with it. It is enough for me. That many questions you will solve in final. So this buy or lease decisions is the like very important for capital budgeting decisions. This buy or lease, they have covered nearly 20 questions in the final. So this buy or lease is a very important capital budgeting decision. Next is research and development. For research and development, suppose you are incurring some expenses in research and development, and how much is incurred, and whether it is helpful for future endeavors. So you can use this capital budgeting to evaluate it. So next is, what are the significance and importance of this budgeting decisions? See, like basically cost. For anything, why we are doing capital budgeting? Simply like how much of cost is involved, whether to reduce, only for reducing the cost and getting the maximum benefit, you are doing this capital budgeting. Next is time. See, you can make profits, of 1 crore rupees even in 1 year or in 10 years also. So this capital budgeting helps in evaluating the time period. Next is risk. See, if you only, the best thing is only you can see, only if you take risk you can get reward. Okay, in life, like normally, if you take risk you can get reward. Same thing applies in capital, same thing applies in this entrepreneurship, or in this business world, everything. If you take risk, you can get return. So if you are taking risk of doing CMA for next 2 years, then you are going to get nice returns. So if you think like whether I'm going to clear or not, then it is like you are aversing, you are like not taking risk, you are avoiding the risk, so there may be not good returns. So this capital budgeting in business terms, it helps in how much is your expected return. Based on that, your risk can be analyzed. So if suppose your expected return is more than 20% per annum, so if your expected return is more than 20% per annum, so you should definitely be ready to lose at least 50% of your capital. So that is the See, I'm not telling every business which is doing more than 20% or no business is doing more than 20% and all. Like I'm telling there are business doing more than 20%. Whereas if you want some nice returns, you should be ready to take risk. So that is called where this risk is helpful in capital budgeting. Suppose there are two options. Like option one is like doing a restaurant business. Option two is like doing uh, some other business, some theater, some other business. So you have to calculate the capital budgeting. Use it for this risk analysis. So you can analyze how much of risk is involved in both the opportunities, and you can take decisions according to it. So next is irreversibility. Decisions are irreversible in nature. Suppose today you have taken one decision that is irreversible. Today if you have taken a decision not to study, then it is irreversible. The time is gone. So the same way, any decisions made in budgeting. For example, suppose your business is giving good returns. Okay, it is giving like 15% return, 15% return per annum. You, instead of being like you have instead of being risk averse, you have been like, okay, let me take risk. You are so aggressive and you invested 10 times of the investment which you made in the business. So because of seeing nice returns, you have invested 10%, like 10 times of your capital which has been already there in the business. So once you have invested in business, once you have taken a decision, then it is irreversible. So you have invested 10 crores, you have purchased all the capital asset, you have purchased all the fixed assets. Then at some point you are seeing that only for up to 5 times of the existing capital can be invested in this business for good returns. More than that is not good at all. Then option is this decision is irreversible. Then you are going to lose your returns. Next is complexity. Decisions are based on forecasting of future events. See, normally future is uncertain, man. So there is always a complexity involved in any decisions which is made using this capital budgeting decisions. Next is surplus. Funds are obtained by the firm at a certain cost. Even internally generated funds have an implicit cost. So see, internally generated funds, which is mean by profits. Suppose, see, you are your ancestral property, you have some nice ancestral properties, so you have already some 10 crore rupees. So you are using the 10 crore rupees, you are investing in a particular business. So even though the 10 crore rupees which you own has been invested in a business, you are losing the other opportunity. Like if suppose instead of investing in that business, if you have purchased some land, you're going to get some long-term benefits. So you are losing that benefits. So this implicit cost, all these, any funds which has been invested in business, no, it is going to lose some opportunity cost. That is, there will be definitely some implicit cost. Which suppose this building belongs to me. Okay, suppose this building belongs to me, and I'm using this building as a house property right now. Instead of using this as a house property, what I'm planning to do is I'm planning to rental it. So I'm going to get some rent. Instead of doing that, I am staying in this one property. So my implicit cost is the rent cost. So that is called using this. Like suppose if I'm instead of staying here, if I'm going and staying in some small rental house, and if I'm leaving this house for some nice rental, then what I'll get? I'll get an extra rental from which I can pay that rent, and I also get some surplus amount. So that is the capital budgeting decision. Using this fixed, this is called land and building. So this is land and building asset. So I'm doing capital budgeting for this particular land and building, means whether I should give on rent or I should itself stay. So that is called capital budgeting. So these are the different importance. Then next is capital budgeting process. See, there are four steps. Okay, what is this capital budgeting process? First, you should understand what is that you are going to do in the project. Okay, first you should have some project in hand. Ultimately, for doing capital budgeting process, there should be one project. So first is generation of project. Like what is the different project which is in your hand? Like suppose project can be classified into new products or expansion of existing products, replacement of equipment or buildings, research and development, exploration, other acquisition of pollution control device. All these are different projects. So you are going to evaluate these projects. Now, once the project has been identified, the second step is to evaluate the project. Suppose you are going to start a business with your friend. You're going to start a restaurant. So the project is starting a restaurant. Evaluation of the project is nothing but what all the different costs I should incur before starting the restaurant. That is, for starting the restaurant, for establishing the restaurant, what all the different costs I'm going to incur and what is the benefit which I'm going to derive from the restaurant. That is called evaluation of the project. Next, suppose I planned a restaurant project and I don't know where to start. That is, in which place to start, whether to start in Tamil Nadu, or to start in Karnataka. So evaluating the selection of project is nothing but I should evaluate all the different places and where my benefits are more, that is net benefits is more, there I will start my project. So that is called selection of project. Next is last point. Till now it is only paperwork. Preparation of, that is establishment of project, then that is identification of project, next evaluation of project, selection of project, all these are paperwork. The last work is like execution of product. Once the project has been selected, the next step is to implement the project. So there are different capital budget. Till now we have understood what is capital budgeting. Capital budgeting is nothing but evaluating different projects. That is called capital budgeting in simple terms. So now the thing is, what are the different capital budgeting techniques? See, there are different n number of techniques for capital budgeting. See, you don't have to be a CMA or CA to do a capital budgeting. Even a person who wouldn't study, you wouldn't go to school itself, but who have earned so much, he did a nice capital budgeting decisions so that he earned so much. Okay, this capital budgeting is nothing but, see, you should not see it as a particular chapter where I should remember this. It's not that. That to this particular capital budgeting chapter, you should think it as a practical thing. See, a person wouldn't go to school, who have no literacy, but then that guy would have earned so much, like crores and crores, only because he did a good capital budgeting analysis. He has did a good investments, so he had earned so much. Don't talk about all those other earning techniques. I'm talking about only a good investments done by the even a person who didn't go to school. He had a nice capital budgeting techniques. He used different techniques in order to ascertain which is very good returns. So he invested in that. So he earned so much of return. So that is called capital budgeting. And there are different techniques in capital budgeting. So the techniques has been classified into two types. So basically there are two types of, not two types, there are so many types of techniques, whereas it has been classified into two types. That is traditional techniques and modern techniques. Okay. Traditional techniques is nothing but techniques which will not take time value of money. Time value of money means today the 1 rupee, today suppose this pen costs 10 rupees, then the 10 rupees amount, no, this pen, leave the pen. Today you have 1 lakh rupees. The 1 lakh rupees value will be lesser when by the progression of time. That is, see, money always reduces, the value of money always reduces due to the inflation. So this traditional techniques, they don't consider this time value of money. Suppose you have 1 lakh today, you should always value it on the basis of present value cost, so that for example, suppose you started a business and you are expecting 1 crore at the end of the year as a return. So 1 crore at the end of the year as a return means today the value of that 1 crore will be cheaper than that 1 crore. That is present value of money. Present value of money is nothing but the value of money today for the future. That is, suppose 2 years later you are going to have 2 crore means you can multiply with the present value factor. I'll teach you, like present value factor. There is a table which has been given in the material last page itself. You can use that present value factors, and also there is annuity factors. We'll do that all when you are doing sums. So as of now, just understand it. This traditional techniques doesn't take this concept of time value of money into account. Okay, suppose you have 1 crore rupees today, it will consider that as 1 crore today also. Even if you keep that 1 crore in your house itself, below your cushion, and also in your cupboard itself, even after 10 years that 1 crore will be 1 crore under traditional techniques. Whereas under modern techniques, it will take time value of money. It will consider time value of money. So if suppose 10 years later, if you are having, from now you are calculating 10 years later, I want 1 crore rupees means you can multiply it with the present value factor, so that you can get arrive at what is the present value of that 1 crore rupees. That is called modern techniques. So what are the different traditional techniques? This payback period which we discussed. So payback period is nothing but period within which you are earning your capital. Suppose you invested 1 lakh rupees in a business. then you are receiving some incomes, like every month you are receiving 10,000 as income or 5,000 as income. When this payback period is nothing but at what point of time you are receiving your entire capital as returns. That is 1 lakh rupees if you have invested in a particular business, then you have to calculate, you have to keep record of all the incomes, then you have to see when you are receiving that 1 lakh rupees from that income. Suppose after 3 years if you are receiving total income received from that particular business after at the end of 3 years is 2,50,000, at the end of 3 years is 3,50,000. So the in between 2 to 3 years you have received your capital as your return, so you have to calculate the 2,50,000 remaining amount 50. See, okay, you have invested 1 lakh rupees, we'll keep like this. For payback period, I'll give you one example. You have invested 1 lakh rupees and you are receiving 10,000 rupees every month. So what is your payback period? When you are receiving 1 lakh rupees return, so 10,000 rupees you are receiving every month. So at the end of 10 months, you are getting 1 lakh. So 10 months is your payback period. Suppose you are getting 5,000 every month. Okay. At the end of first year, you will be getting 60,000. At the end of, when you will be getting this 1 lakh divided by 5,000 every month. So at the end of 20 months, you will receive your capital as return. So payback period is nothing but 20 months. That is 1 year, 8 months. So that is called payback period. Simple. In simple terms, that is the payback period. Next is accounting rate of return, average rate of return. This accounting rate of return, average rate of return is nothing but PAT divided by average investment into 100. That's all. PAT means profit after tax. So whatever you are receiving after tax profit minus after tax profit divided by whatever is your average rate of return into 100. That's all. That is the average accounting rate of return or average rate. Sorry. What is your PAT? That is average PAT. You should add all 12 months profit after tax divided by 12. That is the average PAT divided by average investment. That is at the beginning of the year, what is the investment? End of the year, what is the investment? Divided by 2. That is the average investment made in the business. So average PAT divided by average investment into 100. So that is the average rate of return or accounting rate of return. Okay, this is traditional techniques. It doesn't take it, but this is very important one mark. That is traditional techniques will not consider concept of time value of money, whereas modern technique will consider the concept of time value of money. So what are the different modern techniques? So modern technique is what you are going to see in this particular capital budgeting chapter. So many sums are from modern techniques. So traditional techniques is traditional technique. So you don't have to do any calculations using that. You can just by seeing the question itself without even calculator, you can tell the answer for traditional techniques. Whereas for this modern techniques, you have to do a huge amount of calculations. So there are three different techniques, that is net present value, profitability index, and internal rate of return. We'll discuss about every single topic one by one when we are solving the problems. So net present value, profitability index, and internal rate of return. All these three are modern techniques. So they have spoke about what is payback period. So payback period, there is a formula, that is initial investment divided by annual CFAT. Initial investment is nothing but what is your capital. So suppose 1 lakh is your capital. Annual CFAT. Annual CFAT is nothing but what is the every year you are getting return. Suppose your return is same every year, means you can just put 5,000 into 12. Every month you are getting the same return. So 5,000 into 12, 60,000. So every year you are going to get 60,000. So total amount is 1 lakh. Divided by 60,000 is your every year return. So you are getting 1.66. So your payback period is 1.66 years. So that is called payback period. If your payback period is not same every year, you should cumulatively add it and find what is your payback period. Like how in this sum it is solved. We can see that in the problem. Don't worry. So what are the merits and demerits of payback? Merits of payback is simple. It is simple to understand and easy to compute because it is traditional technique. You can, by seeing itself, you can calculate it. The knowledge of it is useful in decision making. The shorter the period, the better the project. How this payback period should be used to evaluate 3 projects or 2 projects. Suppose you have two or 3 options in your hand, and your boss is telling you to evaluate it based on payback period. Okay, you are evaluating payback period for all 3 options, and you are telling for option 1 payback period is 2 years, option 2 payback period is 3 years, and option 3 payback period is only 1 year. So among these 3, which is the best payback period? 1 year, because you are taking your capital from the return within 1 year itself. So that shorter the payback period is, the better your project. So that is the merits. So demerits, this method is not taken into account of the cash flows received by the company after the payback period. That is, if suppose if you are considering payback period for evaluating the projects, then what you will do, you will just see when is your payback period. Till then you will calculate what is your income, and after that you will just quit it, because you have got your payback period. You will evaluate your projects and you will give the decision. Whereas after payback period, what is your returns, that you won't look into when you are using this payback period as your decision making tool. So same thing, it doesn't take into consideration of time value of money. It doesn't take into account interest factor involved in the capital outlay. All these are demerits. Next is accounting rate of return. Accounting rate of return, as I told, average profit after tax divided by net investment into 100. What is the average PAT? Total PAT divided by number of years. Average PAT is nothing but total profits which you are going to earn in the life divided by total number of projects life. That is called average PAT. So average PAT divided by net investment into 100. You can also do using average PAT divided by average investment into 100. So merits are ARR is simple to understand, easy to operate and compute. Income throughout the project life is considered. So ARR doesn't take time value of money. Then does not consider cash inflows, which is more important than PAT in project evaluation. So these are the different demerits. So next is net present value. See, net present value should be calculated by multiplying your returns into present value factor. That is point number 1. Next, you should deduct what is the present value of cash inflows minus present value of cash outflows. That is total income which you are going to receive from the project. You have to convert all the income into present value, and then summation of it is present value of cash inflows. And what is the outflow? Total outflow, what and all you are going to spend in the particular project. All the amount you should convert into present value. Then it is called present value of cash outflows. When you deduct present value of cash inflows from present value of cash outflows, that is when you are deducting present value of cash outflows from the present value of cash inflows, you should get a positive net present value. If you are getting positive net present value, then the project is acceptable. If you are getting negative net present value, if your net present value is negative, then you should not accept the project. And if net present value is 0, you are in the indifferent point, then you should not accept the project, because there is no use of accepting the project. So what are the different merits? It considers the time value of money, because you are converting all the future incomes into present value. So you are considering the time value of money, and all cash flows associated with the projects are considered. Then since all cash flows are converted into present value, different projects can be compared on NPV basis. So you can compare different projects on NPV basis. So what are the limitations? So in the modern technique also there are some limitations. So what are the different limitations? It involves complex calculation in discounting and present value computations. So simple, you are converting future cash into present value. So it involves more complicated things. That is, you are taking a present value factor and multiplying it with the future value of money, future value of income. So when you are multiplying it, there is some sort of complex calculation. So that is a limitation. An NPV and the project ranking may differ at different rates, causing inconsistency in decision making. It ignores the difference in initial cash flows, size of different proposals, and while evaluating mutually exclusive projects. See, normally using NPV, you cannot evaluate mutually exclusive projects. Only projects which are mutually inclusive, you can evaluate using NPV. The next is profitability index. So what we are finding for NPV, present value of cash inflows minus present value of cash outflows. That is NPV. And profitability index is nothing but present value of cash inflows divided by present value of cash outflows. So where were we? We were in profitability index. Yeah. This net present value is nothing but present value of cash inflows minus present value of cash outflows. Whereas this net present value means present value of cash inflows minus present value of cash outflows. Cash inflows is nothing but what are all the different inflows. All the amount we should convert it into present value, and cash outflows, everything we should convert it into present value. If you deduct both, you will get net present value. If it is positive, accept the project. If it is negative, don't accept the project. Next, profitability index is same values, present value of cash inflow, but divided by present value of cash outflow. If the number is greater than 1, then accept the project. If it is equal to 1, then don't indifference point, don't accept the project. And if it is less than 1, don't accept the project, reject the project. So that is profitability index. An internal rate of return, this is very separate part. This internal rate of return, you should there will be some 2 sums or 3 sums from this internal rate of return, which is very important. You will be calculating what is the return rate, which inclusive of all your discounted cash inflows. Discounted cash inflows is nothing but present value of cash inflows. You will be using that and calculating what is the internal rate of return. We'll go with problems for that particular internal rate of return. So this that is the important thing. And discounted payback period. See, discounted payback period. See, how will you calculate payback period? So I gave you an example of 1 lakh rupees. Every month you are earning 5,000 rupees, and for a year you are earning 60,000 rupees, and for 1 year your annual CFAT is 60,000. So 1 lakh is the total investment you made divided by 60,000 rupees. So within 1.66 years you are getting back your capital as return. So this is payback period. Discounted payback period is nothing but at the end, now if you invest 1 lakh rupees, at the end of 1 month you are getting 5,000 rupees. You should convert that into present value. That is, you should bring that 5,000 to the value today. At the end of 2 months you are getting 5,000 rupees. You should bring that value to the today's value. For every month you should bring that value to the present value. After that you should calculate the payback period. By adding all those cumulatives, you should calculate the payback period. That is called discounted payback period. So below that payback period reciprocal, it is nothing but, if suppose payback period is 1 year, 1 divided by payback period is nothing but reciprocal. That's all. 1 divided by payback period is nothing but payback period reciprocal. Formula for payback period is nothing but initial investment by average annual CFAT, and the reciprocal is average annual CFAT divided by initial investment. So with that we have completed what is capital budgeting and some clarity over this capital budgeting. So now moving on to problem number 5. Move to problem number 9. 9 or 5? Wait, I'll just tell you the problem number. Take that page. Okay, move on to problem number 13. Move to problem number 13. Page number 204. Page number 204. Problem number 13. First problem. Problem number 13. XYZ Limited is considering investing a project required a capital outlay of 2 lakhs. So the total capital investment is 2 lakh rupees. Forecast for annual income after depreciation but before tax is as follows. See, you should always use CFAT, that is cash flow after tax, for purpose of calculating payback period. Cash flow after tax is nothing but what is the PAT, that is profit after tax, plus depreciation. Depreciation is a non-cash expense. So you have received some profit. From that profit you have deducted depreciation, but the depreciation is non-cash expense. So you should add it. Whatever the non-cash expense, only depreciation will be given always in the every sum. So depreciation you should add it back to the PAT, so that you will get what is cash flow after tax, that is cash inflow after tax. So XYZ Limited is considering investing a project required capital outlay of 2 lakhs. So investment is 2 lakhs. Forecast for annual income after depreciation but before tax is as follows. So what are the different depreciation and before tax? 1 lakh, 1 lakh, 80,000, 80,000 and 40,000 for 5 different years. So depreciation may be taken at 20% on original cost. So original cost is 2 lakhs, on that 20%. So they have given original cost, which means what is meant by original cost? That is straight line method. Depreciation may be taken at original cost of 20%. So original cost is 2 lakhs, on that 20% is the 40,000 is the depreciation every year. So, and the taxation is 50% on the net income, that is after PBT, whatever the net income on that 50%. So you are required to evaluate the project according to each of the following methods. 1, payback period. Next, rate of return on original investment, that is average rate of return, and rate of return on average investment, that is also accounting rate of return. Next, discounted cash flow method, taking cost of capital of 10%. So you are asked to calculate discounted cash flow, which is nothing but you should apply present value at the rate of 10%. Next, net present value index method, that is profitability index. Next, internal rate of return method. So all these methods, whatever different methods are applicable in the capital budgeting, everything you are going to see in this one sum itself. So first we will calculate what is payback period, then we will calculate what is rate of return. We will go one by one. So okay, now come to solutions. First we will calculate what is payback period. Come to solutions. Problem number 9. First put the heading capital budgeting. Capital budgeting. Put the heading capital budgeting. Below that, problem number 9, underline it. Problem number 9. Problem number 9. Statement number 1, calculation of payback period. Calculation of payback period. So first we should calculate payback period. For that, what do you want? we need what is CFAT. Payback period should always be calculated on CFAT and not on profit after tax. See, CFAT is nothing but whatever you are received as cash, that is CFAT. PAT is nothing but what is your profit after tax. On that, if you add depreciation, because depreciation is a non-cash expense, if you add that, you will get what is total cash flow after tax. What is the cash inflow? If it is negative, cash outflow. If it is positive, cash inflow. So cash flow after tax you will get. On that only you should calculate payback period. So for statement number 1, calculation of payback period. Below that 6 columnar table. Below that 6 columnar table, first column particulars, second column option 1, that is first year, third column second year, third year, fourth year and fifth year. First year, second year, third year, fourth year and fifth year. So 6 columnar table, particulars, first year, second year, third year, fourth year and fifth year. So below that, what they have given here, annual income after depreciation before tax, EBIT. On that, if you reduce interest, you'll get EBT. So basically, depreciation has been already reduced. That is annual income after depreciation but before tax, which is nothing but PBT, profit before tax. So take down. They have given, see, understand it properly. Whatever they have given, only you should take. Here they have given annual income, that is profit after depreciation but before tax. Before tax means PBT. So they have already deducted depreciation. So PBT, record one by one. First year 1 lakh, second year 1 lakh, third year 80,000, fourth year 80,000, and fifth year 40,000. 1 lakh, 1 lakh, 80,000, 80,000, and 40,000. Below that, see, from PBT, what you should reduce? You should reduce tax so that you can get PAT. So below that, reduce tax at the rate of 50%. Less tax at the rate of 50%. Now calculate. For first year 1 lakh into 50%, how much is the tax? 50,000. So within bracket 50,000. Second year again 1 lakh into 50,000. What you are getting? 1 lakh into 50%, 50,000 within bracket. And for third year, so PBT is 80,000. 80,000 into 50%, you are getting 40,000. So within bracket 40,000. And for fourth year, 80,000 into 50%, 40,000. So within bracket 40,000. And for fifth year, 40,000 into 50%, you are getting 20,000. So fifth year within bracket 20,000. So deduct it. Below that, record PAT. PAT means profit after tax. PAT, 1 lakh minus first year 1 lakh minus 50,000, you are getting 50,000. Second year also 1 lakh minus 50,000, you are getting 50,000. Third year 80,000 minus 40,000, you are getting 40,000. Fourth year 80,000 minus 40,000, you are getting 40,000. And fifth year you are getting 40,000 minus 20,000, you are getting 20,000. 20,000. So that is the profit after tax. So on this profit after tax, if you add depreciation, you are going to get what is cash flow after tax, because depreciation is the only non-cash expenses which has been reduced from the profits. See, normally what you will do with depreciation, you will reduce it from the profit, so your profit will come down. So that depreciation is a non-cash expense. So if you add it back, you will get what is cash flows. You are, by adding it back, you have recorded only cash flow, incomes and expenses. So below that, add depreciation. Add depreciation. Next to depreciation, just open a bracket. How much is the depreciation? They have told 20% on original cost. See, 20% on original cost is nothing but straight line method. They are asking us to calculate on original cost every year 20%. So within bracket 2 lakhs into 20%. Within bracket 2 lakhs into 20%. How much is 2 lakhs into 20%? You are getting 40,000. So all the 5 years record 40,000. All the 5 years record 40,000. That is depreciation, because it is under straight line method. 40,000 under all 5 years. So now total it. Add both profit after tax and depreciation. Record below the depreciation, record cash flow after tax, that is CFAT. CFAT. First year record 50,000 plus 40,000, 90,000. 50,000 plus 40,000, that is equal to 90,000. Second year record 50,000 plus 40,000, that is equal to 90,000. Third year 40,000 plus 40,000, that is equal to 80,000. Fourth year 40,000 plus 40,000, that is equal to 80,000. And fifth year 20,000 plus 40,000, that is equal to 60,000. That is CFAT. CFAT. So we have calculated what is CFAT. Now you can easily calculate what is payback period. Below that payback period. Put the heading payback period. Underline it. Below the 3 columnar table, first column years. Second column CFAT, and third column cumulative CFAT. Third column cumulative. What is meant by cumulative CFAT? first year CFAT will come first year CFAT, and second year CFAT is first year cumulative CFAT plus second year CFAT will get second year cumulative CFAT, and second year cumulative CFAT plus third year CFAT will get third year cumulative CFAT. So that is how you should calculate cumulative CFAT. So payback period, year CFAT and cumulative CFAT. In respect of year, record 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. And in respect of CFATs, record one by one. First year 90,000. You have calculated in the first statement. First year 90,000, second year 90,000, third year 80,000, fourth year 80,000, and fifth year 60,000. Fifth year 60,000. Okay. Okay, CFAT we have copied. So now what is the investment? 2 lakhs. So you should see where is the 2 lakhs of investment that is exceeding. So see, cumulative CFAT, find it. First year cumulative CFAT. What is the first year CFAT? That will be the cumulative CFAT. Record 90,000. Record 90,000. Second year, this first year cumulative CFAT plus second year CFAT, you will get second year cumulative CFAT. So 90,000 plus 90,000, you are getting 1,80,000. In respect of second year CFAT, cumulative CFAT, record 1,80,000. 1,80,000. So next for third year cumulative CFAT, how much? 1,80,000, that is second year cumulative CFAT plus 80,000, that is third year CFAT. You are getting 2,60,000. So that is 2,60,000 is exceeding 2 lakh rupees. So underline it. In respect of second year CFAT, just underline it. 2 years, and in between 2 years to second years, there is some period that is called payback period. So underline in respect of 2 years. Just leave with up to cumulative CFAT of second year. Now come down the payback period. Below that, payback period is equal to 2 plus, that is already we have found that it's about 2 years. So 2 plus, how much is the leftover investment? So total investment is 2 lakhs. Cumulative CFAT of second year is 1,80,000. So 2 lakhs minus 1,80,000, remaining 20,000 is still left. So 20,000, the amount left, that is 20,000 divided by third year CFAT, that is 80,000. Just simply remember it. Whatever the, if suppose payback period is coming between second year and third year, that is in between 2 years, then what you should do is you should record the previous year, that is 2 years year. That is, you should record the previous year plus what is the in between year in which you are receiving. How you to calculate that is, what is the leftover investment? That is 1,80,000. 2 lakh minus 1,80,000, 20,000 is leftover investment, divided by what is the CFAT of the next year, that is third year. So 20,000 divided by 80,000, you are getting 0.25. So 2 is equal to, below that record 2.25 years. 2 plus 0.25, which is nothing but 2.25 years. So payback period is 2.25 years. 2.25 years. Below that, see, we have calculated what is payback period. So payback period is nothing but within which you are receiving your investment, receiving back your investment. So it is 2.25 years for this problem number 13. You understood this, no? Payback period, first you should calculate what is CFAT. That how you can do. Profit after tax plus depreciation is the CFAT. For the CFAT, you should calculate the cumulative CFAT, and this investment amount when it is reaching the maximum, that is 1,80,000. If you add this, 2,60,000. So it is exceeding the third year cumulative CFAT is exceeding the initial investment. So second year CFAT is the final one. So 2 plus, what is the leftover amount? 2 lakh minus 1,80,000, that is the numerator, 20,000. And what is the CFAT of the next year, that is 80,000. So 20,000 divided by 80,000 is 0.25. To 2 plus 0.25, that is 2.25 years. That is the payback period. So below that, what is the second one? B, they are asking rate of return on original investment method. So here you should first calculate what is the average profit after tax. Then you should calculate it divided by the investment, that is original investment, 2 lakh rupees. So below that second statement, below that statement number 2, calculation of rate of return on original investment. Calculation of rate of return on original investment. Below that 2 columnar table. Below the 2 columnar table, first column particular, second column amount. First column particular, second column amount. Below that particulars record, small a. What is the formula for this rate of return on original investment? Average profit after tax divided by original investment. Because they have clarity, they have given a question clearly that rate of return on original investment. So average profit after tax divided by original investment. Whenever they are asking rate of return, you should always take profit after tax. You should not take CFAT. Don't confuse. For payback period only you should take CFAT, and for net present value method and all you should take CFAT. Whereas for rate of return, this is traditional method, you should always take average, that is profit after tax only. So below that particulars record small a, average profit after tax, average PAT within bracket. So now calculate what is the total profits. 1 lakh, wait, just calculate 1 lakh plus 1 lakh plus 80,000 plus 80,000 plus 40,000. You are getting 1 lakh plus 1 lakh plus 80,000 plus 80,000 plus 40,000. You are getting 4 lakh rupees divided by number of years, that is 5 years. So 80,000 is the average profit after tax. So here they have recorded wrongly. Just record average profit after tax. Sorry. Don't do the calculations. 1 sec. This is profit before tax. So we should take the profit after tax values. Sorry. So now come to profit after tax here, after deducting tax. The given amount is profit before tax. See, this is how we will make mistakes. So I have given an example for you. So see, profit before tax minus tax is profit after tax. Okay. So average profit after tax divided by original investment is what you should do to calculate rate of return on original investment. So here profit after tax is 50,000, 50,000, 40,000, 40,000 and 20,000. Just add it. 50,000 plus 50,000 plus 40,000 plus 40,000 plus 20,000. You are getting 2 lakh rupees. So average profit after tax you should find by adding all the profit after tax divided by number of years. So within bracket, in respect of that average profit after tax, within bracket 2 lakhs divided by 5. So we should do it using only profit after tax. Here they have given profit before tax, we should reduce the tax and then only profit after tax. So using the profit after tax only you should calculate. So within bracket 2 lakh divided by 5. Amount column record 40,000. Amount column record 40,000. Below that small b, what is the original investment? 2 lakh rupees. So below that small b, original investment, amount column record 2 lakh. Amount column record 2 lakh. Below that small c, ARR, that is average rate of return or accounting rate of return. Accounting rate of return within bracket A divided by B into 100. A divided by B into 100. So what is the amount? 4 lakh. 40,000 divided by 2 lakh into 100. So that is 20%. So in respect of amount column record 20%. In respect of amount column record 20%. So that is the accounting rate of return. So next what they are asking, rate of return on average investment method. Average investment is nothing but opening plus closing divided by 2. Here opening is also 2 lakh, closing is also 2 lakh. Divided by 2, you are going to get the same average rate of return. But then see, average rate of return here in this sum what they have did is 2 lakh opening plus closing divided by 2. Closing we have not invested any amount, whereas the closing amount is 0. So divided by 2 you are getting 1 lakh. So they are dividing 40,000 divided by 1 lakh into 40, so 40%. See, project requiring a capital outlay of 2 lakh. Okay. Opening investment plus closing investment divided by 2, that is you will get average investment. So opening investment is 2 lakh rupees. Closing investment is 0 rupees. So divided by 2 you are going to get 1 lakh rupees. So that is the average investment. So statement number 3, below that statement number 3, calculation of rate of return on average investment. Calculation of rate of return on average investment. Below that 2 columnar table, first column particulars, second column amount. First column particulars, second column amount. Below that particulars, small a, average profit after tax, within bracket same amount 2 lakh divided by 5, because profit after tax is not changing. So average profit after tax is 2 lakh divided by 5 within bracket. Amount column record 40,000. Amount column record 40,000. Below that small b, average investment within bracket 2 lakhs plus 0 divided by 2. So 2 lakh is the opening investment, closing investment is 0, whole divided by 2. So 2 lakh plus 0 divided by 2. Amount column record 1 lakh. Amount column record 1 lakh. So below that small c, Therefore, rate of return within bracket A by B into 100. Rate of return A by B into 100. So amount column 44 lakhs 40,000 divided by 1 lakh into 100, that is 40%. In respect of amount column record 40%. So that is the rate of return on average investment. That is the rate of return on average investment. Below that, small Roman number 4, calculation of NPV of project. Calculation of NPV of project. Calculation of NPV of project. So the next point which you are going to calculate is NPV. But see carefully, see here, discounted cash flow method they have asked. Okay, this is how they will confuse us in exam. Discounted cash flow method is nothing but NPV method. Okay, many students will get confused when they are giving different terms for different techniques. Suppose for a particular capital budgeting technique, they will give a different term which they're not going to give a new name and all. They're going to use some term which has been given in the theory, that they will use as different term, so that we have to find the net present value method. Here they have given discounted cash flow method, which is nothing but net present value method, that is NPV method. Below that again they have given NPV index method. So NPV index method is nothing but profitability index method. That is next to, we have seen that in next to NPV method. If you are thinking that okay, they have already asked NPV, then what is this discounted cash flow? They are confusing us. Simply that discounted cash flow method is net present value method, and net present value index method is nothing but profitability index method. So statement number 4, calculation of NPV of the project. Calculation of NPV of the project. So calculation of NPV of the project. Once again we have to check whether they have attached the present value factors in this material. So that it will be easy for us to check the values. They have attached. Okay. See, come to page number 204 itself. See, problem number 13. D, point number D, discounted cash flow method, taking cost of capital as 10%. So the present value factor should be analyzed using 10% values. That is cost of capital as 10% they have given. So present value factor should be taken at the rate of 10%. So below that 4 columnar table, first column year, second column CFAT, third column present value factors, fourth column present value. Year, CFAT, present value factors, and fourth column present value. In respect of the third column present value factors, below that record within bracket 10%. Within bracket record 10%. So in respect of years, below that record 5 years, that is 1, 2, 3, 4, 5. Record 1, 2, 3, 4, 5. So copy the CFATs. See, always for net present value you should take CFAT. You should not take profit after tax. CFAT is cash flow after tax. On that, if you multiply present value factors, you will get present values. So copy CFATs. They have calculated in the first statement, that is for first year 90,000, second year 90,000, third year 80,000, fourth year 80,000, and fifth year 60,000. So 90,000, 90,000, 80,000, 80,000, and 60,000. These are the different CFATs for each year. So that is the CFAT. Now next is present value factors at rate of 10%. Now moving to the present value factors table. Now take page number 246. Take page number 246. Just understand the concept of taking the values for present value factors. Leave this first. First we will analyze how to take present value factors. So in exam you don't have, see, some people, some intelligent people, what they'll do is they will remember all the values right from 1% to the some 16-20%. They'll keep repeating in the exam. All those 1% to the 20% from first year to 10 years, they'll remember numbers. So you don't have to remember numbers. You can do it using this table itself. It is very easy to calculate the table, or you can even use this calculator to find the percentage, what is present value. So in exams what they'll do is behind the question paper they'll attach one more paper and they'll give what is the present value interest factor, or else they'll give directly what is the present values also. That is present value factors also. That is for first 1% for first year is 0.990. Below the question itself, they'll give the values, that is factor value. So how to calculate present values? Now 10% we have taken. Okay, so present value interest factor, from that table 10% is the cost of capital given in the question. Okay, so come to the 10%. So this is the 10%. Okay, for 10%, if you are investing 1 rupee today, then at the end of 0 year, that is today itself, the value of that 10% is, for 10% that value of the money is 1 rupees, because today you are investing, present value is 1 rupee. Suppose after 1 year, then 0.909, after 2 years 0.825, after 3 years 0.751. So this is how you should calculate what is present value. Now we are calculating 10% present value factor because they have given cost of capital 10%, and for 1 to 5 years. So take the numbers of the 10% from 1 to 5 years and copy it. That's all. See here for first year, what is the present value factor? 10% for period 1. So 0.909. So copy it here, 0.909. For 10% for first year, what is the present value factor? 0.909. And for 10% for second year, what is the factor? 10% for second year factor is 0.826. So copy it, 0.826. This is how you should calculate present value factor. Simple. You should see what is the percentage and you should see the number of years, that is which year you want. So percentage and the year, if you see the which matrix it is fitting in, that is the present value factor of that particular question. So here next third year, 10% third year. So 10% third year, how much? 0.751. So in respect of the present value factor for third year, record 0.751. And for fourth year, 10% how much? 10% for the fourth year, 0.683. So in respect of fourth year, record 0.683. So fifth year, 10% fifth year. So 10% fifth year, 0.621. So record 0.621. These are the present value factors. So if you multiply this with the CFAT, you will get present values. So multiply it. Now multiply CFAT with the PV factors, present value factors. You will get what is present values. So 90,000 for first year, 90,000 into 0.909. You are getting 81,810. For first year, present value column, record 81,810. For second year, record 90,000 into 0.826. You are getting 74,340. So present value factor, present value column, record 74,340. Next third year, 80,000 into 0.751. 80,000 into 0.751. You are getting 60,080. So present value column, record 60,080. So next is fourth year, 80,000 into 0.683. 80,000 into 0.683. You are getting 54,640. So in respect of fourth year, record present value 54,640. 54,640. Now calculate for fifth year. 60,000 into 0.621. You are getting 37,260. So present value column, record 37,260. So that is the present values of the different cash flows. So now summation of all this is the present value of total cash inflows. So total it 81,810 plus 74,340 plus 60,080 plus 54,640 plus 37,260. You are getting 3,08,130. Below that, underline it, 3,08,130. In respect of the 3,08,130, record present value of cash inflows. Present value of cash inflows. Below that less present value of cash outflows. Present value of cash outflows. See, for 10% for the today, that is 0 years, how much is the present value? 1. Okay, so now come to the question. How much is the total cash outflow? 2 lakh rupees, that is invested today. So 2 lakh rupees invested today at the rate of 10% cost of capital. At 10% cost of capital, the today present value for today is 1. So next to that, open a bracket, 2 lakh into 1, close the bracket. Next to present value of cash outflows, open the bracket, 2 lakh into 1 and close the bracket. So in respect of present value column, record 2 lakh within bracket, because that is the present value of cash outflows. Present value of cash outflows. So 3,08,180 minus 2 lakh. you are getting 1,08,130. 1,08,130. Total it and record it in below column, that is below row, 1,08,130. So in respect of that 1,08,130, net present value, that is NPV. So simple thing, how to calculate NPV, CFAT into present value factor, you will get what is present values, multiply all, add all those present values, you will get what is present value of cash inflow, from that deduct what is the present value of cash outflow, you will get net present value. That's all. So that is the calculation of net present value. So next what they have asked, point number E, net present value index method. So net present value index method, see, net present value index method is nothing but profitability index method. So PI is the net present value index method. They are just twisting the names. So below that statement number 5, profitability index, that is PI is equal to present value of cash inflows divided by present value of cash outflows. Present value of cash inflows divided by present value of cash outflows. Below that is equal to 3,08,130 divided by 2 lakh, because we have calculated both the values in the net present value calculation. Present value of cash inflows 3,08,130, present value of cash outflow is 2 lakh. So divide both, 3,08,130 divided by 2 lakh, you are getting 1.54. That is profitability index. So with this we have calculated what is payback period, rate of return, that is accounting rate of return, then NPV, then profitability index. Now the last one, that is IRR. How to calculate IRR? See, IRR, there is a procedure for calculation of IRR. For calculating the IRR, we'll just solve this problem so that you will understand how to calculate internal rate of return. Okay. So first, what is internal rate of return? Internal rate of return is nothing but return which is expected after calculating the discounted cash flows. So here we are calculating what is the discounted cash flows. On that discounted cash flows, we should calculate what is the return rate of return. So that is called IRR. So put the statement number 6. Statement number 6, calculation of IRR. So below that, point number 1. First, what you should do for IRR is we should calculate fake payback factor. So point number 1, fake payback factor is equal to what is the formula for payback period? Initial investment divided by cash flow after tax. That is what we have seen in the payback itself. So if you are having similar, that is constant CFAT, that is same CFAT for every year, you can find the payback period by dividing initial investment divided by average CFAT, that is CFAT. So here we are calculating what is the average CFAT. We have already calculated what is average CFAT. So on that, like initial investment, if you divide average CFAT, you will get what is the fake payback ratio. So fake payback ratio is equal to initial investment divided by average CFAT. Initial investment divided by average CFAT. Here what is the initial investment? 2 lakh rupees. And what is the average CFAT that we should find? Here what is the CFATs we have calculated? Just summarize all the CFATs. You will get what is the average CFAT. So 90,000 plus 90,000 plus 80,000 plus 80,000 plus 60,000. You are getting 4 lakh divided by 5. So 80,000 is the average CFAT. So record. Below that is equal to 2 lakh divided by 80,000. Initial investment divided by average CFAT. 2 lakh divided by 80,000. You are getting 2.5. So fake payback factor is nothing but 2.5. So using this fake payback factor, you can find what is the internal rate of return. So 2.5 is the fake payback factor. Okay. See, at 2.5 falls between 28% to 32% that we have written. How we are calculating that is, see, payback factor is 2.5 and total number of years for which the project is given is 5 years. So under 5 years, we should see at what rate, at what percentage this 2.5 is falling in present value factors. So here we have found that fake payback factor is 2.5. Okay, that we are very clear. Fake payback factor can be calculated by dividing initial investment from the average cash flow after tax. So initial investment divided by average cash flow after tax, you will get 2.5. That is the fake payback factor. And what is the time period of the project? 5 years. So now moving on to present value factor in that is present value factor table. Present value factor table. What is the fake payback factor? 2.5. And what is the years? 5 years. So come to the period 5 years. Now see where this 2.5 is falling in the annuity. Sorry, you should not check this payback factor in the annuity present value factor table. See, first understand this both. Okay, present value factor is nothing but for every year how much is the present value, that is present value factor, and annuity factor is nothing but summation of all. That is, see, for 10% will 10% itself will consider 10% for now it is 1 rupee for present day. For 1 year ending it is 0.909. For 2 year it is 0.826. So here at the end of 2 years, how much is the value under annuity factor? 1.736. This 1.736 is nothing but summation of first year and second year. That is 0.909 plus 0.826. You are getting 1.735, which is nothing but 1.736. So this is how you will, this annuity factor. Annuity factor is nothing but for 1%, first year plus second year will be the second year value. For third year, first year plus second year plus third year of the present value table values will be the third year value. For fourth year, first year value, second year value, third year value plus fourth year value, summation of that will be the fourth year value under this annuity table. So this annuity is nothing but summation of the present value factors for every year. So this is the difference between present value interest factor table and the present value of interest factor for annuity table. Okay. So now see, come to the annuity table. Here fake payback factor is 2.5, man. Okay. 2.5 is nothing but it's the payback factor. And what is the years? 5 years. Initial investment, that is for project is for 5 years. So under 5 years, you just check where this 2.5 is falling. 5 years under 1%, 4. It continues to 3 at 8%. 13% is not there, and below that 14%. From 14% just see 5 years under, see the value is 2.5. So 2.5, so it is falling between 24% and the 28%. So it is 2.5, no, it is falling between 28, that is 2.532 and 2.345. It is falling between 28% and 32%. Okay, see the value is 2.5, man. 2.5 is in between 2.532 and 2.345, because 2.5 is 2.532 is greater than 2.5 and 2.345 is lesser than 2.5. So it is falling in between the 28% and 32%. So fake payback factor is found only to calculate the two different rates under which this fake payback factor is falling. So here 2.5 is falling between 28% and 32%. That is what you should find using this fake payback factor. So now coming to the answer, below that point number 2, at 2.5 falls between 28% to 32%. That is, present value factor 2.5 falls between, sorry, it is not at, that is annuity factor of 2.5 falls between 28% to 32%. Annuity factor, we are using annuity table to calculate the fake payback factor value. That is, for calculating value, what is the formula? Annual investment divided by average CFAT. So average CFAT we should find, what is the annual investment we should find. If you divide both, you will get fake payback factor, and you should see where that fake payback factor falls for the project life. That is, project life is 5 years. So under 5 years, you should see where that fake payback factor is falling. Here in this particular sum, it is falling between 28% to 32%. So point number 2, annuity factor AF of 2.5 falls between 22% to 32%. So now what you should do for this 28% and 32%, you should calculate what is NPV. That's all. How we calculated net present value for statement number 2, same thing you should do here. 28% and 32%, both the values you should calculate what is the net present values. So below that, statement number 3, point number 3, calculation of NPV at various discount rates. Calculation of NPV at various discount rates. At various discount rates. So for 28% and 32%, you should calculate. So below that, 6 columnar table. Below that, 6 columnar table. You can even put 8 columnar table. Put 8 columnar table. First 4 columns record Year CFAT present value factor at 28% and present value. First 4 columns record. Divide the page into 8 columnar table. Give some nice space and record 8 columnar table. 8 columns. First column years. Second column CFAT. Third column present value factor at 28% and fourth column present values. So that is the calculation of 28% present values, and put a line after the 4 columns, put a big line, and next to that record again year CFAT present value factor at 32% and present value. If you don't want this both year and CFAT because the page is not available, that is page is not available, you can even remove that if you want. If you can understand that this PV factor is multiplied with this CFAT again. Okay, just remove that if you don't want it, or if you have written, it's well and good. You don't have any confusions while calculating. So present value factor at 32% and present value. Now come to the first column, year 1, 2, 3, 4, 5. Years record 1, 2, 3, 4, 5. CFAT. Next to that CFAT record, we have already calculated what is CFAT. Take down 90,000. First year 90,000. Second year 90,000. Third year 80,000. Fourth year 80,000 and fifth year 60,000. 90,000. Second year 90,000. Third year 80,000. Fourth year 80,000 and fifth year 60,000. So that is the CFATs. Next to that, present value factor at 28%. So at 28%, you should see what is the present values for all 5 years. So you can do that only using present value table, not the annuity table. So this present value table interest factor only you can use. So 28% for 5 years. So where is 28%? It is here. And for 1 to 5 years, you should copy it. First year record, in respect of first year, record present value factor at the rate of 28%, record 0.781, 0.781. In respect of second year record 0.610, second year record 0.610, and third year record 0.477, third year 0.477, fourth year 0.373, fourth year 0.373, and fifth year 0.291, 0.291. So I'll tell you one more technique of calculating present value factors. Okay, one more technique of calculating present value factors. So that we will do for this 32%. So now, as of now, present value factors at the rate of 28% we have found. So multiply CFAT with the present value factors. So first year 90,000 into 0.781, you are getting 70,890. 70,890. 70,890. Second year 90,000 into 0.610, 610. 70,000 into 0.610. Sorry, 90,000 into 0.610. You are getting 54,900. 54,900. Third year 80,000 into 0.477. 80,000 into 0.477. You are getting 38,160. 38,160 in respect of third year. Next fourth year 80,000 into 0.373. You are getting 29,840. In respect of fourth year record 29,840. Fifth year 60,000 into 0.281. 60,000 into 0.281. You are getting 16,000.281. So 60,000 into 0.281. You are getting, how much is the value for 291? So sorry, this one 291, no. So 60,000 into 0.291. You are getting 17,460. In respect of fifth year record 17,460. Now summarize all the present value factors. Total it. Total all the present values. Total all the present values. You will get 2,10,650. 2,10,650. 2,10,650. So next to that, again year column record first year, second year, third year, fourth year, and fifth year. CFAT column again copy it. Copy the CFAT 90,000, 90,000, 80,000, 80,000, and 60,000. Again record both year column and CFAT column. Record both. Then present value factors at the rate of 32%. present value factors at the rate of 32%. So I told you how to find present value using calculator. I'll tell you. So see, take the calculator. Take the calculator. Here for 32% we are calculating. Okay. So for calculating the present value factors at 32%, first 1 divided by what is the percentage? 32. So 1.32. You are getting for the first year 7.57. 7.575. So for 7.58. Again press equal to. You will get 0.5734. So second year 0.74. So again plus equal to. You will get 0.435. Then again equal to 0.329. Again press equal to. You will get 0.250. So the values will be the same. So present value factors can be calculated just by dividing 1 divided by 1 point, what is the percentage? 32. So 1.32. You are getting first year present value, second year present value, third year, fourth year. By clicking on the equal to, you'll just getting each year present value. So that is the another method of calculating present value factors. So just copy down. For present value factors at the rate of 32%, 1 divided by 1.32. You are getting 0.756 for the first year. Sorry, 0.758 for the first year. Second year 0.574. Third year 0.435. Fourth year 0.329, and fifth year 0.2550. Fifth year 0.250. So that is the present value factors at the rate of 32%. So now multiply the CFAT with the present value factors at the rate of 32%. What is the CFAT for the first year? 90,000. So 90,000 into 0.758. You are getting 68,220. So in respect of present value column, record first year 68,220. 68,220. Second year 90,000 into 0.574. 90,000 into 0.574. You are getting 51,660. 51,660. Third year 80,000 into 0.435. 435. You are getting 34,800. 0.435. 34,800. Fourth year 80,000 into 0.329. You are getting 26,320. Fifth year 60,000 into 0.250. You are getting 15,000. So in respect of fifth year record 15,000. So total all the present values. Total all the present values. You are getting 1,96,000. You are getting 1,96,000. So that is the present value of cash inflows for the 32%. So for 28% present value is 2,10,650. For 32%, 1,96,000. That is the present value of cash inflows. Below that present value of cash inflows, record minus less present value of cash outflows. Less present value of cash outflows. Both the column record 2 lakhs within bracket. Under the 2,10,650 record 2 lakhs within bracket, and under that 1,96,000 record 2 lakhs within bracket. You are getting net present value. So now deduct it. 2,10,650 minus 2 lakh, you are getting 10,650. 10,650. Now total it 10,650, and 1,96,000 minus 2 lakh, you are getting within bracket 4,000. Negative value of 4,000. So 4,000 within bracket. In respect of that values, record NPV. In respect of this value, record NPV. So this particular calculation is nothing but NPV calculation, but we are doing for 2 times. That is 28% and 32%. So below that, very important segment, take down. Point number 4. See, always when you are calculating the net present value and discount rates for IRR, one value should be positive and one value should be negative. Then only you can calculate IRR here. If suppose if this is not positive, if this is negative, then calculate at higher percentage. That is, now you have calculated 32, then go for 35%. If then also positive, then go for 40%. It is up to you. Lower band and the higher band, it's up to you to select. You can select whichever lower band and higher band you want. Lower band, no problem. You can select the nearby one. Higher band, you can select whichever point you want. So 32, if it is positive, then calculate for 35% and go with it. So basically for IRR, NPV should be, one should be positive and one should be negative. So below that, point number 4, take down the formula. IRR is equal to, that is internal rate of return is equal to LR, L small r, which is nothing but lower rate. Here lower rate is nothing but 28%. Whichever the rate is lower comparatively, 32 and 28, 28 is the lower. So 28% is the lower rate. So LR plus, open a bracket, LR plus, open a bracket, NPV at the rate of LR, NPV at the rate of LR divided by NPV difference. NPV difference, that is lower rate LR minus higher rate LR. Lower rate LR, lower rate LR minus higher rate NPV. Lower rate NPV minus higher rate NPV into LR. Actually, this is not LR, this is LD. One second, we'll just check the formula before writing the formula. Okay, DR, this is DR into DR. DR is nothing but difference rate. Difference rate is how much is the difference between two rates? That is 32 minus 28, you are getting 4. So 4 is the DR. So this is DR, difference in discount rate. So the formula, once again, I'll repeat it. Whether you have taken rightly, just note it down. IRR, internal rate of return, is equal to LR, which means lower rate, plus within bracket NPV at lower rate, that is your lower rate is 28. So NPV of this lower rate divided by NPV difference, that is lower rate NPV minus higher rate NPV, close the bracket, into DR, that is difference in rates between LR and higher rate, lower rate and the higher rate. So LR plus NPV at lower rate divided by NPV into difference, NPV by NPV difference into DR. So below that is equal to, what is LR here? LR is 28%, because higher rate is 32%, lower rate is 28%. So record 28 plus, open a bracket, what is the NPV at the lower rate? At the lower rate 28%, NPV is 10,650. So numerator record 10,650 divided by, what is their NPV difference? So lower rate is 10,650, lower rate minus higher rate we should do. So 10,650 minus of 4,000. So it will become plus. Minus 4,000 means it will become plus. So plus 4,000. You are getting 14,650. So denominator record 14,650. Simple. NPV difference is nothing but lower rate NPV minus higher rate NPV. Here lower rate NPV is 10,650 and higher rate NPV is minus 4,000. So 10,650 minus, within bracket, minus 4,000. So minus into minus, it will become plus. So 10,650 plus 4,000, you are getting what is the NPV difference. So NPV difference is 14,650, and close the bracket. Close the bracket into DR. DR is nothing but difference in rates. So 32 minus 28, you are getting 4. So into 4. So what is this? Now solve it. 28 plus 10,650 divided by 14,650. You are getting 0.726. That is 0.73. So within bracket 0.73 into 4, you are getting 2.92. 0.73 into 4, you are getting 2.92 plus 28. Below that record 28 plus, within bracket 0.73 into 4, close the bracket. Below that is equal to 30.92%. 30.92%. So internal rate of return is 30.92%. So this formula is the only thing which you should remember. Whereas other things and all is quite common things. That is, to calculate IRR, first point is calculate what is fake payback factor. That is by initial investment divided by average CFAT. Initial investment is the, once again, now we have finished this problem number 13. Yeah, problem number 13. So we are doing this IRR. Yeah, IRR. See, 4 points you should remember. First, you should calculate what is payback factor. That is calculated by initial investment divided by average CFAT. You will get what is payback factor. That payback factor 2.5 for this particular example. 2.5 you should find where it is falling. So suppose this 2.5 is falling between 28% and 32%. So for 5 years, you should check what is the life of the project. On the 5 years, you should check where this 2.5 is falling in the annuity table. In the annuity table. Only for this annuity table is helpful. So after finding that, you should calculate NPV for both the rates. That is where in between what rates it is falling, you should calculate NPV differences. That is NPV present values for the both the rates. If suppose it's better to take bigger gap like 28% and 40%, because so that one value will come in negative. So 28% and 32% here we have taken. So for 28% calculate the present values, 32% calculate the present values. Then use this IRR formula, calculate the IRR percentage. That is the problem number 9. So with this, we have done the introductory part of this capital budgeting. Next video, we'll start off the, we'll just cover off all the problems. Nearly some 20 problems are there. You just have to work on all the problems. Whereas some problems will be like repeated things that you can itself solve. So these kind of problems and all you can solve. One problem, if I solve one problem, you can solve. So with that, we have completed this problem number 9. We'll see in the next video. Thank you.